Are you being crushed by the weight of massive student loans? Do you lie awake at night, wishing you can make them all just disappear? Do you want to buy a huge house, drive a fancy car, with no effort on your part? If so, then this video probably isn't for you. That said, if you're looking to reduce or eliminate your student loan payments as part of a comprehensive financial strategy, then keep watching. What you learn might surprise you. It certainly surprised me. Hi, I'm John. Like many of you, I have some fairly significant student loan debt. How significant? Nearly $200,000. Before we get started, here's the obligatory disclaimer. This video is for entertainment purposes only and is not financial advice. Before putting anything in this video into practice, consult a professional.
Professional what?
A few years ago, I decided to start planning my financial future. While doing the math, which included some absolutely ridiculous spreadsheets, I came across a concept known as FIRE. FIRE stands for Financial Independence, Retire Early. While this isn't exactly my goal at the moment, I have incorporated some of FIRE's principles into my financial plan. One key concept of FIRE is that of the 4% rule. The 4% rule says that in order to retire and live off your investments, you need to be able to pay all of your expenses using 4% or less of your total investments. Said another way, you need to have 25 times your yearly spending invested in order to retire immediately. For example, if you spend $40,000 per year, you need 25 times that, or $1 million invested in order to retire immediately. Note that this is spending that we're talking about here, not earnings. The next concept is that of geoarbitrage. Geoarbitrage is just a fancy word that means living someplace cheap. I first encountered this concept in Tim Ferriss's book, The 4-Hour Workweek, but the FIRE community uses this concept as well. When I first started doing my financial planning, I intended to combine these principles so that I could retire earlier than would be normally possible in the United States. By living someplace cheap, like the Philippines or Colombia, you don't need as much money invested to make the 4% rule work. For example, if you can live someplace like the Philippines on $10,000 a year instead of $40,000 a year, like in the previous example, then you only need $250,000 invested. This is obviously still a lot of money, but it's a much more attainable goal than $1 million. Nothing I've said so far is new, and this information is already well known to many people. The part that nobody knows, as far as I've seen, is something that I came across by chance. This is the part you've been waiting for. While I was running the numbers for retirement, I became concerned about what would happen to my student loans. I thought to myself, moving someplace cheap and retiring early is great and all that, but is it even feasible to do this when the federal government is taking a huge chunk out of my wallet every month? So I went to the Department of Education's website and I entered the amount I intended to live off of in retirement to recalculate my student loan payments. I saw the number and literally started giggling to myself. If somebody had been watching, I might be locked up right now instead of making this video. The payments dropped to zero.
No way.
This has got to be a mistake, I thought. But as I dug into the nuts and bolts of how student loan payments are calculated, I realized that it is no mistake. Payments on student loans can be zero. Here's the thing. The federal government only considers your taxable income when calculating your loan payments. They don't consider assets. You can have more money invested than Warren Buffett, and your student loan payments can still be zero as long as your taxable income is low enough. If you have $2 billion invested, but only withdraw $10,000 per year to cover your expenses, then, in the eyes of the IRS, you are essentially the same as a starving college student. Keep this up for 20 to 25 years, and depending on your payment plan, any remaining balance on your loans will be forgiven by the federal government. For most people, this isn't useful information. It's difficult in the United States to live off an income low enough to reduce your student loan payments to zero. Also, What's the point racking up all that debt going to college if you're just going to live barely above the poverty line? The fact that many people don't consider this before choosing a major is not something that I'm going to get into here. The key is being able to voluntarily reduce both your income and expenses at the time of your choosing. For example, I'm a pharmacist. I make just over 6 figures a year. This is a good wage, but completely unremarkable in my profession. Approximately 1/3 of my wage goes to taxes. Another third goes to expenses. The last third goes to investments. At this rate, I could retire to some place like the Philippines in 6 years, even if I started from zero. I could then contact my loan servicer, tell them that my situation had changed, report my new income as $10,000 per year, watch my monthly payments drop to zero, and live happily ever after, having my loans forgiven after 15 years because I've been paying for almost 10 years already. This is just one scenario, and your plan doesn't have to look exactly like mine. Maybe you start an online business and relocate someplace cheaper. Maybe you get yourself a job where you can work remotely, use Geoarbitrage to reduce your expenses, invest more, and retire earlier. Maybe you're into extreme frugality and can get by in the United States living on an amount that most people would think impossible. The possibilities are endless and are only limited by your imagination. To get this particular student loan debt reduction strategy to work, however, you need 2 key elements. The first is income reduction, and the second is expense reduction. With that covered, there are a few key caveats. First and foremost, your student loans must be under an income-driven repayment plan or be eligible for one. If you leave your loans under the default payment plan or have consolidated loans, this will not work. Keep in mind that if you change your loans to an income-based repayment plan and they haven't been on one previously, the outstanding interest on your balance will almost certainly be added to your principal. This is called capitalization. This is bad, but it's probably better than paying off the entire amount of your loans. So if you have any questions about that, be sure to check with a financial advisor. Second, and of almost nearly equal importance, when your student loans are forgiven, the amount that's forgiven is treated by the IRS as taxable income. So let's say you get to the end of your 25 years. You have $100,000 remaining on your student loans to be paid. The federal government forgives that $100,000, but it's treated by the IRS as if an employer had given you a check for $100,000 and is taxed accordingly. Fortunately, this amount is far less than you would have paid conventionally because A, you are paying only a fraction of the original loan amount, and B, the true cost of your payment is lower because of inflation. You'll need to plan in advance to take the lump payment into account when making your financial projections. However, if you invest wisely, your portfolio should be able to handle this without any problem. Another thing to consider is Public Service Loan Forgiveness, or PSLF. PSLF is a program available to government or qualified employees of nonprofit businesses. Unlike standard loan forgiveness, public service loan forgiveness only requires 10 years of payments, and the remaining balance is forgiven tax-free. I repeat that, it is forgiven tax-free. I haven't been able to come up with any scenario under which I would be better off in the long term by doing anything other than becoming eligible for PSLF. After years of trying, I have finally been hired by a PSLF eligible employer in the last year. This is the reason why I'm no longer planning on retiring immediately as my goal. If you can qualify for PSLF, just do it. So that's it. Please share, like, and subscribe if you feel that the information in this video has been useful to you, or if you think that it might be useful to somebody else. I have no plans to become a professional YouTuber, so this doesn't really make much of a difference to me personally. But if this helps somebody else, I think that's worth taking a few moments of your time to like, share, and subscribe. Who knows? If there's enough positive response, I might do more videos like this. If you have any questions or concerns, please feel free to voice them in the comments down below. Speaking of comments, I'm sure someone will say,
But Dad, Dave Ramsey and Graham Stephan say that I should pay off my student loans as soon as possible. Dislike, unsubscribe.
no disrespect to Dave Ramsey, but he gives advice that's geared more towards someone who has trouble managing money to begin with. He does not, in my opinion, give financially optimal advice. If you're someone who has trouble with impulse control, then you will likely have problems making this plan work. How do you know if you have problems with impulse control? If you look at your bank balance after every paycheck and you start thinking of all the ways that you can spend that money, then you might want to listen to Dave Ramsey and not me. As for Graham Stephan, I respect him a lot, and I think he gives solid financial advice. This should be obvious to the Graham Stephan fans watching this video. I do, however, disagree with him when it comes to paying off student loans. The reason why is because student loans do not compound unless you do something to cause them to. Unlike credit card debt, which grows exponentially, student loan debt grows linearly. This makes the true interest rate for student loans significantly lower than the equivalent amount of credit card debt. Because of this, it's more appropriate to think of student loan debt more like a mortgage and less like a credit card. Someone may be watching this and say,
But Dad, this is just gaming the system.
yeah, maybe. I'll leave ethical concerns like this up to you. It's up to you and your financial planner, of course, to decide how to handle your money. I'm just providing information. If you'd like to learn more, I provide some links in the description down below that I think may be useful to you. I hope this helps, and thank you for watching.